Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist with OptionsPlay, and welcome to today's presentation on Gamma and on zero DTE options. So before we get too far along, I want you to know that every Thursday we do an educational event. It's at 4:15 as soon as the market closes, and we address very timely topics. One of the most recent ones that we did was Tony Zhang, the chief, or the senior, or I should say the chief option strategist, came out and talked about what his favorite indicator was. A very well received presentation that we did before. We're going to try to knock these things down to about a half hour, but I have a really good presentation for you to try to dig deep into how short-term zero DTE options work and why they move the way that they do. So before we get into that, I want to also say that we're going to be showing some real live examples today using the OptionsPlay platform, and nothing's meant to be a recommendation, and past performance is not a guarantee of future results. So with that said, if you'd like to sign up for the OptionsPlay platform, please feel free to do so by scanning this code, 30-day free trial. And definitely want to check out some of the tools that we're going to be showing you today, and we're going to really get into more of the definitions today through that PowerPoint. Also, every Monday morning, Tony talking about that indicator that he discussed most recently on our YouTube channel is he also every Monday morning does a deep dive into anywhere from 5 to sometimes even 7 or 8 stocks. And these are stocks that we actually use for the daily play. So we put out a daily play trade almost every day. And sometimes things don't pop up, but almost every day. And a lot of that is based off of this research. And a lot of this research actually comes a lot from Tony's favorite indicator. So if you'd like to learn more, please scan that. You can sign up right now and you'll get all the reminders for all the events every Monday morning. All right, option pricing. So we're going to jump right into it. If you have any questions during this event, we do try to make this as interactive as possible. And you use the Q&A box for the questions. If you want to chat amongst yourselves, you can use the chat box. The Q&A box is the box that actually has a question mark on it. All right, just so you know. And I'll try to address them during the show. And I already see a couple of people, we obviously have some old timers in here that have already started to chat this up. Will it be recorded? Yes. And it's usually in the normal YouTube icon. All right, so here we go. So the price of the asset. So the more expensive the underlying, the more expensive the option contract. So like if you think of just buying car insurance, is it going to be more pricey to buy car insurance on a Bentley or a Ford Taurus, right? The price of the asset does matter. So we're talking about fairly pricey option contracts. Even if you're looking at the SPY, that's still a $600 ETF as opposed to a $6,000 index like the SPX. And these are the ones that we're going to focus on. Obviously, you have the NASDAQ. You have some ETFs that trade options on them, but the real liquid option contracts is what we're going to kind of talk about today. Strike price, that actually helps you determine the deductible. If you're thinking of your option contract as a put option and you are buying insurance on a stock, the difference from where the stock is to where the strike price is the amount of deductible. That's the amount of risk you're willing to take. Stock's at 100, you buy the 95 strike put, you got the $500 deductible insurance policy. So that is figured in. Time is money. We're talking about zero DTE. A lot of premium in these options, even on a zero DTE basis, on a one-day basis. But expiration does matter. Interest rates and carry costs. Yeah, cars don't pay dividends, but stocks do. So we figured that in. But when you pay for your car insurance, when do you pay for it? At the beginning of the term or at the end? You do it at the beginning, right? So the insurance company earns interest on your monies that you paid over the life of that contract. You don't get the benefit of earning the interest on them. And if they get a really good interest rate, they're supposed to give you a discount on your next 6-month policy, which in the utopian world, that's the way it would work. But ideally, that is the thought of it. Now, in the options world too, if you sell an option or if you buy an option contract, somebody sells that to you, they take your cash, and with that cash, they can actually earn interest over that. So that's how carry costs work. They're all figured into the price of an option contract and an insurance contract. And then we come down to volatility. In the options trading world, we call it implied volatility, what the marketplace is implying the volatility to be over the life of the option contract. In the insurance world, you're talking about the level of risk. This is why actuaries get paid so well. They need to try to figure out mathematically what's the risk of a 25-year-old father of 4 teacher driving around a Chevy Caravan versus a 25-year-old man that just came out of the Navy SEALs program, where might just driving a Ford Mustang and might just drive the car off the cliff as a training exercise. There's a lot of difference in risk between those two profiles. In the stock world, we have that type of thing too, right? So Ford is going to have a lot less risk than Tesla. And obviously just even the price of the underlying stock fits into that. So when you talk about Ford, you're not paying up for those option contracts. They're lower price stock trading around $10, and they just don't have that level of risk. So the volatility isn't priced into those option contracts. Once you figure it all out, we call the price of an option a premium. Where did that come from? The insurance world. That's why we call it the premium for your option contract. And it's all because they are priced like an insurance policy. All right. So let's get into the good stuff. So let's spend the next 20 minutes deriving this formula. No, why would we do that, right? It's the Black-Scholes formula. It's the first pricing model that is out there. But everything that we talked about is in here. You see a lot of square root signs. We're going to bring those up too. We're going to talk a little bit about those because we'll get into theta a little bit today. But everything, this simple little formula was the first formula ever used to try to price option contracts. So the Fisher Black and Myron Scholes, the Greeks. You put everything into this formula and guess what you get? You get a delta, you get a gamma, theta, and vega. And what are they related to? All the variables that are in the pricing model. We're going to really focus on delta today. Delta is, well, I'm just going to say them quick. You can read them if you want to. But delta is based off of the movement of the underlying stock, how much your option should change relative to the movement in the underlying stock. It's so important that they gave it a sidekick, and that sidekick is gamma, and that's what we're going to focus on today. So gamma tells you how much delta changes when the underlying stock changes. And then we got theta. Theta is time decay, and vega is volatility. We're not going to really focus on vega today, but we'll talk about theta and gamma because they go hand in hand. Delta. All right, so a lot of people have probably seen this scenario, I guess. Delta, the amount of a theoretical options price will change for a corresponding 1 point change in the price of the underlying. Now, if you really want to understand zero DTE options, you have to understand this concept of delta. So in this scenario, just a very, very XYZ gray scenario as far as what delta is concerned, most option contracts, if it is an at-the-money option contract, will have a delta close to 50. But delta is dynamic. So if the stock is at 50 and the strike is 50, at that instance, we have a 3-month call option in our example, and that's trading for $3. Stock goes from 50 to 51. We know the delta is 0.50, and that means that if the stock goes up 1, our option should go up by about 50 cents. Now, in the real world, it's dynamic. It's going to go up a little bit more than 50 cents, but we're going to keep things simple here. And when that happens, that means that your option goes up 50 cents, but that also means that you made $50 on your one option contract because each option contract represents 100 shares of stock. Okay. Now, the next point movement, things now start getting a little tricky. Will the delta change? No, the delta actually increases as you get further and further in the money. This is one of the reasons why a lot of people like to speculate on options and not use them as insurance, but to speculate, because as the stock goes up, you get more delta, or effectively it acts more and more like 100 shares of stock, right? So in the next point movement from 51 to 52, the delta actually increased. It increased by 10, and now that delta is 60 cents, and it went from $3 to $3.50. Now it's at $4.10. And in the next point movement, if it went up another dollar like that, snap, we would even go up more than 60 cents. And that's how delta works. Why are we jumping in leaps and bounds by delta? Well, I always like to talk about the non-textbook definition of delta. The non-textbook definition of delta is the probability of the option being in the money on expiration. All right, I'm going to say that one a little bit slower. It's the probability of the option being, I'm going to even say 1 cent in the money on expiration. Okay. So the stock is 50, strike is 50. I told you the delta was 50. Well, if you look at this textbook definition, what's the probability of it being in the money? We're right at the money. If it ticks up, we're in. If it ticks down, we're out. So delta is going to be somewhere close to 50. Now, in the real world, on a call option, it's a little bit skewed. It might be 52 or 3 or 4. And the put option would be 46, 47, 48. And that has to do with interest rates and stuff like that. But always keep in mind that in a utopian world or a theoretical world, if the delta on the call is 50, the delta on the put has to be 50, because they always have to add to 1, right? And I'll say that again. Think about that. So if the delta on the call is 55, the delta on the put has to be 45. In a theoretical options pricing world, that always happens. Now, there's hard to borrow situations on shorting stocks. It doesn't always work out perfectly in the real world, but in general, it's pretty accurate. Okay, and we can highlight some of those when we look at a chain. Okay, so delta is the probability option being in the money on expiration, 1 cent in the money. So when the stock goes from 50 to 51, now what's the probability of it being in the money? I don't know exactly, but it was higher than it just was, right? It was 50-50 there. Now it's 1 point in the money. So it makes sense that it is that delta has increased, and then it gets to 52. Now the probability is even higher. We still got the 3-month call option. We don't have any time decay in our example. But with that said, we're now 2 points in the money. The probability is higher. The delta is higher. That's simple. Now, it's a non-textbook definition. It's fairly accurate. A lot of people use it as probability of that option finishing in the money. But it's not the correct the correct definition. This is the correct definition of it. Okay, just want to keep that in mind. But if you're down on the trading floor, I've worked at the CBOE, which used to be called the Chicago Board Option Exchange. Everybody talked in delta. So, for example, hey, Billy, down on the trading floor, you want to do lunch today? Oh, 10 delta. It's really busy down here. I'm slammed. Okay, market's closed. Billy, you want to go over to the Cactus, which used to be the bar right across the street from the Chicago Board Option Exchange. It's not there anymore, which makes me sad. But, hey, Bill, you want to go to the Cactus for happy hour? Oh, 90 delta on that. Everything had a delta, and that's how everybody would talk. It was all about probabilities, because delta is the staple to the market maker. It lets them know by just looking at their position how much exposure they have to how many shares of stock, or how many shares of stock short that they have if they're long a bunch of puts or different trades. But delta, the definition of probability is what drives it. And this will help you understand zero DTE options. All right. All right. So let's go to the extreme. Let's make this a 1 day to expiration option contract. The market is closed. We have 1 day. The market's not open. We're not at 0 day. We're literally just waiting for the market to open. So we literally have 1 full day of trading. The stock is 50, the strike is 50. Remember this definition. Delta is the probability of the option being in the money on expiration. We said, all right, and that's the symbol for the Greek symbol for delta. And we say the stock is 50, the strike is 50, our delta is 50 with 1 day remaining. All right, 60 days to expiration. We just did this, right? 60 days, stock is 50, strike is 50, delta is fairly close to 50. It might be a little bit bigger, but it's fairly close to 50. All right, now, stock goes to 51. All right, 1 day remaining to expiration. They're both at the money. Is this delta really 50? Think about that for a second. Is it 50? There's 1 day remaining to expiration. You can't get more 50 than that, right? If it's exactly at 50 and the strike is 50, that's exactly a 50-50 chance of, if it even ticks 1 penny up, it's in. If it ticks 1 penny down, it's out, right? You can't get more 50-50 than that scenario with the stock at 50 and the strike is 50. But here comes the question. Stock now moved to 51, as we see on the slide. What's my delta? Stock is 50, strike is 50, 1 day remaining to expiration. You can put it in the chat box if you want to play my reindeer game. What's the delta now? Okay, here we go. 50-50. And I love all the answers, because what this tells me is we need help developing a realistic expectation as to how much your option's going to move when the underlying moves. Somebody said 85. That was close. Some people said 51. Like we're barely in the money, so the delta is barely going to go higher. We say greater than 50, close to 100, a couple of people. Some people say 1. And Wally hits it on, I guess it's Whaley 2, hits it right on. It's 90, and that is the answer. So if you think about the non-textbook definition of delta, this answer is fairly obvious in that stock is 50, strike is 50. We go from 50 to 51. The delta goes up. The stock goes up by 50 cents. The next point movement, now it's moving the whole way. So once again, remember, it's going to go up a little bit more than 50 cents because it's dynamic. It's going to go up a little bit when it goes up 25 cents. When it goes up 50 cents, it's going to grow. But in this instance, the delta jumps from 50 to 90. And this is even more dramatic in zero DTE options that you buy at 10 o'clock a.m. on the open and sell at 4 p.m. on the close, New York time. Those option contracts are even going to have more explosive delta and gamma, and it's just from a simple 1 point movement in the underlying stock. Now, just to finish the slide, if you go back to the 60 days, this right here is the reason why people like zero DTE options, and is also the reason why people hate zero DTE options, right? Is how much delta moves and how quickly, when you're right, you get paid, and how fast you lose money when you're wrong. And it's all about delta. Guess what we just defined by going through this slide? We defined gamma. That movement is called gamma. When the delta jumps from 50 to 90, the gamma was about 40 in that instance. And in a simple 1 point movement of the underlying stock, all of a sudden, this option contract is acting like 100 shares of stock. Well, 90 shares to be more accurate, right? But that's how quickly it moves. And that whole slide was put together using a theoretical pricing model. So it's not like we're saying in the real world it does this, but in theory it does. In theory, it does it exactly like the real world. And that's exactly how gamma works. So obviously, gamma is highest for the near term at the money strike and slopes off towards in the money and out of the money strikes. And that's very true. So you're messing with fire when you're looking at buying an at the money or selling an at the money 0 DTE option because of that potential movement that is in the delta of that option contract that you're buying. All right. So, do you like gamma? Well, if you're going to be right, you do. You do like gamma. Now, here's one of the biggest downsides of gamma, and this is always a trade-off. If you like high gamma, guess what you're going to get? You're going to get high theta. The most at-the-money option contract also has the most juice in the option contract, and theta decay is going to be large. So theta is the amount a theoretical options price will change for a corresponding 1 unit or 1 day change in the days to expiration of the option contract. Now, when you look at theta on a 0 DTE option contract, it doesn't help, right? The model kind of breaks down anyway. You got 0. There's no time decay at the end of the day. It's that simple. Whatever time decay you paid for is going to go away at the end of the day. I don't care if it goes in the money, goes out of the money, it stays at the money. By the end of the day, the time decay, the time value that you paid for that option contract is gone. Okay, so I do have a slide, and oh shoot, it moved my. This is kind of this, like I said, I always like to say, everybody sitting down, you ready for this concept? Options decay at the square root of time, and we showed you that in the Black-Scholes model. But the Google slides moved my little icon over. But bottom line is as expiration approaches, options decay at an accelerated rate. Time value is cheap as you go further out in time, and it decays faster as the expiration approaches. So a 1 month option, you pay $1. If you go to a 2 month option, you're paying $1.41. 1 times the square root of 2. Go to a 3 month option. If this is trading for $1, 1 times the square root of 3 is $1.73. And it's that straightforward. And this actually works well. This formula, even though this is assuming a perfect scenario of you only have 1 month, 2 month, and 3 month options, and you're talking about a 360-day year. But in general, the square root of time thing kind of works. You look at a 1 month option and you multiply that by the square root of 2. That's going to give you a fairly accurate price, even in the real world, of what a 2 month option would trade for. Okay. Bottom line is, this is the graph. And everybody that's probably on this call kind of knows this, or on this webinar, that when a 90-day becomes a 60-day, you got a more linear rate of decay. When a 60-day becomes a 30-day, now you got a little bit more of a slippery slope. And then in the 30-day down to 0, it's like, wham, my sled hit the tree, right? I got to go all the way down to 0 in that instance because it's got to go away. So we're starting right here. This is where we're starting on a 0 DTE option, right? But that wouldn't be a very exciting graph. So I went out 90 days to go with it. All right. And I'm seeing some questions pop up. I'm almost through the slides. And yeah, okay. So the trades that we're going to talk about, and if you haven't watched this event, I watched it, I took notes on it, and did a lot with it. But Tony Zhang and Tom Sosnoff, who is a good friend of mine, I've known Tom for a long time, since all the way back when he started Thinkorswim. As a matter of fact, I used to do seminars for Thinkorswim on Tom's behalf. But all the way back to that, they talked about a lot of the research that Tasty Trade has done relative to 0 DTE options. It's a great presentation. It's an hour long. Listen to the whole hour. You will enjoy it. But one of the things that was focused on was short vertical spreads. And that's one of Tom's favorite trades to do on 0 DTE options. And I agree with that too. And it has everything to do with the gamma and the theta dynamic that we just talked about. And that's why I wanted to start this event by answering that. So before we get into short vertical spreads, let me try to answer a few of the questions that I have here over on my other screen, because I see quite a few of them have popped up. Because this presentation is really about, now this applies to everything, right? Understanding that concept. If you understand the concept that delta is really the probability of the option finishing at least 1 cent in the money towards expiration, you can almost look at any option chain and look at a 30-day, 60-day, 90-day, and have a pretty good feel for what delta should be, right? Just by kind of understanding that concept. If I go out further in time, deltas are going to kind of flatten out, right? Because the probability of it finishing at that level as the expiration approaches, well, there's a good chance that it can move away because there's a lot of time, and there's a good chance that it could move in. So delta kind of flattens out over the curve. Now, on the shorter term, delta is either going to be 1 or it's going to be 0. It's that simple. So shorter term option contracts are going to have a very steep delta curve in that instance. And that's all based off of that non-textbook definition. Okay. What does the hourly decay look like on a 0 DTE? Yeah, that's what I mean, Barry. Barry, there really is no way to figure that number out. So that's the first question. Yeah, you're not going to, theta breaks down. You just know what it is. If you want to, you can take the time premium in your at the money option contract and divide it by the number of hours in a day, and that's probably going to be fairly accurate. But it does escalate as the expiration approaches, especially when you're looking at a high price underlying, which I include the SPY in that and the SPX. All right. Now try to keep it in the Q&A box. That's the best place to go. And I'm going to scroll up. I got 3 in here. All right. And then we got some in the webinar chat. Okay. This is not pertinent. All right. How do we know what strike price to use on the daily play if the stock moves overnight? Can you reply to me privately if you want? Roy, I'll address this because this has came up a lot. If the stock does move overnight, it is a daily play. It is an indication of it's not an active auto trade platform, right? So we're picking the trades overnight and we're trying to get you ready for the market. What I would look to do if the market has really moved is adjust the strikes, kind of keep the same setup, go the same amount out of the money as you did on the initial setup of the daily play. And what Roy is talking about is inside a feature of OptionsPlay. We use a lot of Tony's research, and every once in a while, if I find one that I like, I trump Tony's research and we'll do a trade just on my own. But we always are using the OptionsPlay platform to pick the underlying stocks, and then we're doing the setup and using the tools inside the platform to come up with the setup. One of the things that we do is we do daily plays, and some of them are based on earnings and they have a little bit different dynamics, but some of them are just standard short call spreads, bull call spreads, et cetera, et cetera. And sometimes the market will move a lot before people get a chance to put them on. So that is the issue. The answer is, Roy, either you let it go on the daily play because it's moved too much, and that's very true, or you adjust the strikes to make it very similar to the trade that we put on to start with. Okay? But there's no great answer to that one, Roy. I want to sell credit put spreads on for specific stocks. How do I do it on OP? We will, and this recorded and posted on YouTube. The answer is yes. All right, so let me go into the webinar chat. We're at 450. Okay, we're about at max here. Yeah, zero DTE options, and type in Tom Sosnoff and Tony Zhang. And maybe if Philip, who is part here with me, if he can find that link, maybe he can toss it into the webinar chat. All right, and then okay, so this is the zero DTE trade, and I'm really feeding off. A lot of people like to just buy options, but you know what? That's a real tough way to do it because you're dealing with bid-ask spreads, and you got to be right so often. If they move against you, they move against you hard. If you win big, right? It's really that simple. So I want to get at least one thing on my side. And the biggest thing that I can get on my side is if I'm doing a short vertical spread. So another term for it, and in the OptionsPlay platform, we call them vertical spreads, but it's probably better well known as a bull put. This is actually the terminology down on the trading floor, but it's probably in the rookies world, it's a bull put spread or a bear call spread. So if you sell calls, you're bearish. If you sell puts, you're bullish. Now you're selling an expensive put, buying a cheaper put, that is considered a bull put spread. Neutral, and you're neutral to bullish or bearish on the market. So if I'm doing this trade, the setup that we usually look for inside the OptionsPlay platform, and we don't have something at this point in time for just a 0 DTE, but a lot of times we like to sell at the money option contracts and try to get a decent risk reward on that. And that can happen, and that's very feasible in the SPY, and that's what we're going to focus on today. All right. So I did just zero this out, but I'm starting to run out of time. 1 second. These slides will be made available to you, but this outlines what a bull put spread is, and this outlines what a bear call spread is. I'm going to show this up one more time. Please don't forget to try out OptionsPlay because I want to get to OptionsPlay. And lastly, my name is Brian Overby. If you'd like to follow me on x.com, my handle is @BrianOverby. Here's the website. You can sign up for the free trial by going there, OptionsPlay.com. And I wrote a little book, and that book is actually called the Options Playbook. And if you'd like to check it out at OptionsPlaybook.com. And there's a link to Amazon if you did want to buy the book. Okay, so let's exit this, and we will go to here. And in particular, when you look at setting up the SPY, we're going to look at an SPY trade. The market is up a little bit today. Not bad. 0.75% is where we closed. 611 is where the SPY is at. I always like to click on high implied volatility because that gives you the vertical call spread and the vertical put spread, the two trades that we just outlined in the slides. Now, I'm just looking at we got bullish. The market's looking bullish. Everybody's cheery. VIX is down. We're all happy. Life is good. The sky is not falling. Let's look at modifying this trade. So here's the trade that we have set up. We're going to modify that. I always like to work off the midpoint as opposed to the bid and ask when we're looking at trying to get a good feel for the strategy. And a lot of, like in the SPYs, they're so liquid. Feeling close to the midpoint is very feasible if the market doesn't move against you. And then we're going to go all the way down to 1 day remaining to expiration because it is Thursday. So this is literally 0 DTE, right? You got 1 day for this to live. June 27th is the expiration date. I'm going to adjust the strikes. We almost always default to something near the money. And in this instance, that is also the case. So you got 87 cents. I kind of like this, about 1 point away from where the strike is at. We're going to sell the 610 put. And this is what I mean. You got $1.20 for 1 day for an at-the-money option contract. What's the delta? It's going to be close to 50, right? Exactly. And I like to try to go down. And if I'm going to go 5 points wide, I want to get about 20% of that 5 points, which is $1 here. So if I'm going to go 5 points wide on this trade, and it's all about your risk tolerance and what you're looking to do, but this is, I don't mind doing this way in my own account. We're going to look at the 606 strike, 606 strike. And that's about 20, oops, I did the wrong one, didn't I? Dang it. 611 and 606. And please work out for me. Be close to $1. 5 points wide, 606. 91 cents. All right. Maybe we do the 605, but we're close. We're close enough. Now, if I'm doing this trade, and one of the things that Tony and Tom talked about is because of that gamma bomb, because of that gamma explosion, Tom mentioned their research shows that you want to get into this trade as quickly as possible and get out as quickly as possible. In other words, you don't usually ride it all the way to the expiration date. So if I'm putting it on for 90 cents, and the market moves with me, and I can get out and I can make 25 to 30 cents, I'm going to do that. And I'm hopefully going to do that by noon on the day for the 0 DTE. Okay. And that gives you a real nice theta decay. If it goes against you, it's going to go against you hard, but it doesn't cremate you like it does right at the expiration date. And if you're going to get out, a lot of times we'll say, well, if we're looking to make 30 cents on the upside, we are going to remove and go down to 60 cents. If this thing is trading for 60 cents against us, we'll get out of the trade. But Tom also mentioned that on the downside, depending on the width of your strikes and what you're looking to do and your risk reward overall, that a lot of times you can just let it run. Just let it ride all the way to that expiration date. Now, that's more feasible to do in the SPY because you don't, or SPX, because you don't have to deal with the stock. If we're in the SPY and you get assigned and you exercise your option contract, you buy stock, right? And you trade stock. The SPX is just cash settled. The OptionsPlay platform does not support the SPX, mainly because of the quoting situation and where the quotes come from. But we are looking to try. We're looking into it. So I'm showing you an example in the SPY, but doesn't mean you can't apply the same concepts to the SPX if you'd like. And then I'm going to create a new portfolio. And I'll show you how to do this inside our platform here. Portfolio name will go 0 DTE, and we're going to create that. And now if this is a trade that I'm interested in doing, this means I'm bullish on the marketplace. I'm going 5 points wide. I'm bringing in close to $1. My risk is going to be $4. So if I say to myself, I'm going to get out if I got double the price, it means I'd be closing it at $2. I'm hoping to make 30 or 40 cents. If the market stays where it's at, I can make that in a couple of hours time with the theta decay. If the market drifts up, I can definitely make that sooner rather than later on that scenario. But if the market goes down, I got to be prepared to get out of the trade. And if I'm following this, I'm going to click add to the position. And then we're going to go over to the portfolio, and inside the OptionsPlay platform, we have a 0 DTE portfolio. It puts all the price in. It allows you to track it. It allows you to day trade it. It's based off of obviously the market's closed, but it's going to execute it based off of the midpoint if you want. If you want to do it on the bid or ask, that's fine. But the market is fairly tight in the SPY. And then you can do things like close it. If the market opens tomorrow and you want to close it, you click on the position and you click close position, and then you click trade, and it will wipe the position out. And that will allow you to see your profit and loss, allow you to follow along with those positions inside the portfolio, and learn how to trade 0 DTE options. Now, I will go out and show inside the watch list. Here is the other portfolios. We'll get rid of the 0 DTE. That's the daily portfolio. And we have a few positions on right now, but Google, Microsoft, Micron Technology, that actually went down a little bit today, I think, after hours. But we already actually rolled that position, or we closed it out and opened a new one. We got longer term positions like Charles Schwab. Here's the 0 DTE trade that we put in because we got both the portfolios here. USO trade, that one's bounced back a little bit, and we're down a little bit on the Walmart trade. All right. So if you're looking at the other side of the coin, we'll go back and then we'll call it a day. I'll answer any other questions. But if I'm looking at the SPY and I want to use high volatility, I want to hit the short call spread, I click trade. and I want to click modify, hit bid and ask spread, go all the way down to 1 day to expiration. 1 day to expiration. It's selling the 612, doing the 620. We'll go up to the 612, 617, somewhere around $5. Yep, and that's also trading close to $1. $1.11. All right. Well, we're a little bit over at this point in time. I'll answer a couple of more questions. Yes, can you do them with the NDX? Yes, the NDX does have zero DTE options. How do you manage the gamma risk? You know, you don't manage it, Sid. You can't. You set your goals and you get out. This isn't a. If you want to try to manage gamma risk, Sid, you don't do zero DTE options. It's that simple. Where do I see the P&L? Right here. Like, for example, I'll look at one that's up and one that's down. We did an Airbnb that's down, unrealized profit and loss that's down 40%, and the Google is up 620 or 63%. All right. Let's go back to the SPY. Zero DTE webinar by Tony and Tom. That's excellent. Somebody put that in. There it is. All right. I think that's going to be it, guys and gals. Michael says, would you use a stop or a stop limit? I would, if you're doing zero DTE, Michael, I don't think stops or stop limits are really appropriate. If you're going to trade them, you got to trade them. You got to watch them. You could do alerts, and you could literally do the alert on the stock if you'd like to. I don't mind. I definitely don't want to stop based off of a short put spread. I might do that on a single leg option contract if I just bought a call or just bought a put. But I always use stop limits, especially when it comes to spread, where I'm saying if the midpoint of the spread gets to this price, activate my order. I'm losing money, activate my order, and then send a limit order to the marketplace. But zero DTE is, if you're going to be trading them, you need to be active. You need to be around. One simple mistake can wipe out a lot of gains. About 20%. That's usually what I'm looking at. So even if you're doing 2 points wide, right, you're looking at 20 cents, right? So some people want to keep the risk tight and they do the 2 point wide one or the 3 point wide one as opposed to the 5.1 one. About 20%. Yep. All right, everyone. Well, that was a great show. I usually have a tendency to go long, so this wasn't bad for me. It wasn't a half hour, but it was a little longer. Remember, every Thursday we do option education, so join us. We want to make option traders out of everyone if we possibly can. Sign up for the free 30-day access to OptionsPlay by clicking this, or by getting your phone up and clicking the banner, or going to optionsplay.com. And we'll see you next Thursday for the next edition of OptionsPlay Education. And I always like to leave you with a little bit of hope at the end of my events, and like to say that I hope that all of the option contracts that you buy finish in the money, and all the ones that you sold finish out. Thanks for tuning in.